You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, take two, Brandon.
Yeah.
Welcome back.
Yeah, sorry. Sorry for wasting your time before.
We had a bit of a false start before.
Yeah, we did.
Brandon wasn't ready.
No, I didn't have my headphones in. So I realized because I'm just watching the waveform of our speech. And when I stopped talking, the waveform kept moving.
Oh, yes.
Then I realized that my microphone was picking up everything that you said as well, which is an absolute editing nightmare when that happens. Oh, yeah. That sucks when you have to try and edit out someone else's, like when it's two audios that, it's just nasty.
Yeah.
Anyway.
We get that when we do our live podcast.
It's hard to avoid it.
Yeah, because we have the two microphones and we're in the same room. So obviously
everything gets picked up.
Yeah, the other microphone picks up at least a little bit of the other mic of the other person speaking, and then that's always a bit of a nightmare to edit.
So it's so nasty. It's so nasty. But anyway, all right, we're on track now. Sorry.
We're on track.
Wasted a couple of minutes of your time there. Anyway.
No, not at all. And what we started with on the first attempt was we were talking about how Bill Ackman is no longer an investor in Berkshire Hathaway.
Yeah.
Which is big news because Bill Ackman is a famous billionaire investor. He made a stunning investment in March that is kind of unbelievable to comprehend. It was where I think he turned about $26 million into $2 billion or something. It was some ridiculous short sale investment.
Oh, it was a short. Okay.
Yeah, he shorted the market like the week before it dropped, which is kind of crazy. But he's obviously a famous investor, and he's done very well over time. And him dumping his stake in Berkshire Hathaway is big news. It's kind of like I feel as though this news story is kind of like the face of so many people who believe that Warren Buffett is no longer someone to admire in terms of investing. And I think we probably...
It's a big call.
Yeah, it is. And I certainly disagree with that. But
yeah, I disagree as well.
But there's definitely a big sort of movement of people that's kind of, I guess, they've kind of grown over the past few years in particular from what I've seen, of people saying, well, he's underperformed the market and that he has so much cash, he's not even investing money anymore.
Yeah.
And he's been selling when the market's been dropping, and he bought into the airlines, notoriously debt-heavy businesses, and then he sold them for a huge loss.
Yeah.
And it's kind of all of these things that have just kind of come together particularly in the last couple of months to sort of make people question whether he's still got it.
Yeah. I reckon we should talk about this in more depth. I reckon let's get through the sponsorship clip and then let's talk about it a little bit more, because it is a very interesting topic to get through.
Yeah, absolutely. Yeah. So today's episode is sponsored by Sharesight, and Sharesight is an application that I've personally been using over the past few years in order to track the performance of my stock portfolio. And it is fantastic for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out your capital gains, dividend income, and more. And you can try Sharesight for free. There's a free plan by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And after you try out the free plan, if you're interested in signing up to a paid plan, you can also use that link to get 4 months free when you sign up to a yearly subscription. So go check that out if you're an investor, particularly if you're in Australia, as we are coming up to tax time.
Definitely. Thanks, Sharesight, for sponsoring, as always. Yeah, so getting back into this Warren Buffett stuff, it is pretty interesting because I've heard it a lot as well, just simply from reading YouTube comments lately that, I've made a couple of videos about Warren Buffett and specifically what he was talking about in his annual meeting, and how he did say that he sold the airlines at a probably at least a 50% loss, and he's still sitting on 135 billion dollars of cash, and the market dropped 35%, and he didn't even he just didn't really buy heavily at all. So there's definitely, and like I go straight to Warren Buffett's defense because the man's the flippin' world's best investor, and he's maintained that title for so flippin' long. Like it's unreal. So like the guy definitely knows what he's talking about.
Yeah, and I mean this certainly isn't the first time that people have questioned whether Buffett's run is over.
Yeah.
Pretty much every time that the market is on a huge tear and that valuations are really high, and there's been any kind of period of 3 to 5 years or more where growth businesses kind of speculating on high growth companies has outperformed value investors, during any of those periods, which might have happened maybe 5 to 10 times over the past half century, people have questioned Buffett as an investor and said, well, if you're not even investing during these periods and you're clearly underperforming the market. So it's certainly not the first time, but it's the first time that I guess both of us have been around to experience it happening on a day by day or a week by week, month by month basis.
You know what I'd say? I'd probably say that if Buffett kept investing for the next 20, 25, 30 years, then I think that he would see that the stocks that he picked would underperform the market quite drastically, just because I feel like obviously in the future, so much of company success is going to do with technology. And technology is just something that Warren Buffett really doesn't understand that well. Like he's made a big investment in Apple, but I mean, he doesn't even use an Apple phone or anything like that. So I feel like if we continued, like just because Warren Buffett hasn't really kept up with the latest in technology, I feel like he would eventually just lose his lose that title of world's most successful investor. But I certainly feel like with his circle of competence, he could still make very, very good returns for the years to come.
So Buffett he's had sort of this view of avoiding companies that are in fast changing industries and in sort of new technologies that he doesn't understand.
Yeah.
But now that we've kind of had computer tech and we've had internet tech for quite some time now, there are some businesses in those industries that are very well established. And even though they are technology companies that Warren Buffett doesn't understand, they're businesses that I would say that you could value using sort of traditional value methods, looking at future cash flows and that sort of thing. And they're not necessarily sort of bleeding edge technology companies that are in markets that sort of don't exist yet. And you're right. I think Buffett is going to be missing out on a lot of those investments. I mean, putting money into Apple was kind of a sign that he was trying to head in that direction and stay with the times, I think.
Yeah, that's true.
But I mean, there's a certain point at which you've just lived so much of your life without this technology that is it even possible for you to develop a deep enough understanding to invest in those businesses? I don't know. Probably not, I would say.
Yeah, that's true. But I just think of listening to what Elon Musk was talking about recently with Joe Rogan, and when he was talking about the technology that Neuralink's developing. And, if it pans out like Elon, what he's predicting, then like how different a society we would live in, how basically everything we do would be digital. It's like for someone like that's just a drastic shift in society. And if that even happens in 50 to 100 years, that's so much different to the world that someone like Warren Buffett's used to. But yeah, I don't know. I don't think he's lost it. No way. He's still the world's best investor. Like, come on. And here's the other thing, right? So he's a value investor, and you kind of touched on this before. Value investing works really well, or it lets you get money into the market when across the board things are really cheap. But it's the value investing strategy stops you from putting money into the market naturally when things are really expensive. So it's not like Warren Buffett's just sitting back and not trying to get money into the market. He says he'd still be very interested in a deal that could be like potentially 10, 20, 30, 40 billion dollars. But it's just the fact that this value investing strategy doesn't really allow you, because we wait for prices to be at margin of safety, it doesn't really allow you to get money into the market unless things are cheap. And if you look at the investing environment over the past like 3, 4, 5 years, things have not been cheap. It's been like incredibly hard to find cheap businesses. And even though I remember us talking about this, the market went down by 35% throughout March, we were still kind of scratching our heads. We found some businesses that came to margin of safety prices, but there were still so many great businesses that we are interested in that just was still overpriced.
Yeah. I think there's definitely a couple of things at play here. One is that I think, at least on average, business valuations are much higher than they have been historically on average. The other thing is that the types of businesses that Buffett can invest in due to his size are just there's such a limited number of businesses.
That's very true.
I wanted to sort of give you some statistics just to show you how challenging it might be for someone like Buffett, where he has $130 billion in cash. And remember, following Buffett's classic principles, he only wants to invest in a handful of businesses. So ideally, he's looking for maybe a portfolio of 8 businesses that he's deeply studied over time.
Yeah.
And having that small number of businesses is kind of out the window for Buffett at this point, because Berkshire Hathaway owns lots and lots of businesses outright, and then they have tons of businesses in their portfolio, even though, it's relatively concentrated, but they own a lot of businesses. So that's kind of already gone. But I just wanted to draw an example. Let's say he wanted to invest that let's say it's about $100 billion, and he wants to invest it in 5 companies. And let's say he also wants to be a less than 10% owner in each, because ideally you don't want to have to report constantly. That means that he needs to find 5 $200 billion plus valued companies. So 5 companies that are worth $200 billion or more. And this is to just invest in 5 companies.
That's insane.
He might even want to put that $100 billion into less companies. But I then went to look at the S&P 500, so the biggest companies in the US. There are 19 companies on the S&P 500 worth $200 billion or more. And of those 19, he owns 2 of them. I think one was JP Morgan and the other one is Apple. And there's one other one in that 19. That's Berkshire. That's him.
So what? He's got 16 more opportunities potentially in America.
Yeah. So I'm just kind of spitballing an example where he might put money into 5 businesses. Maybe he does it into more, but 5 seems like, the way that 5 or less, I would say, is sort of where Buffett would want to be spending that money.
Definitely.
And that he could basically count the number of businesses that are big enough on his fingers, let alone find one that is a really solid business following his principles and also cheap.
Yeah.
The way the environment that Buffett is operating in is nowhere near the average person who could be following the Warren Buffett strategy. And that's not to say that there's tons of opportunities available right now, but I think if you're investing $100,000 or even like $1 million, you're investing a relatively small amount of money. You're not working with a handful of businesses in total. You're working with tens of thousands of businesses, literally, of which are all across many different industries. And of which, even when the market is expensive, there will be industries, there'll be pockets of the market, there'll be individual businesses that are struggling and that will see opportunities where you could invest. And I guess the point I'm trying to make here is that I think he's still a great person to follow in terms of the principles that he invests under, but you can't be exactly following him. It's not as if, Warren Buffett has 50% of his money of the stock portfolio in cash, so I should too. That's not necessarily how it should work. It should depend on the opportunities that can present themselves to you, and they very well will be different to the ones that Buffett can invest in.
I'm just thinking about an example that we've been talking about recently. a company called Texas Roadhouse, and I just drew them up because we've been talking about them and how they've been posting some really impressive growth numbers, and the CEO is really managing the company well, and they've had great growth over a long period of time, and all that sort of stuff. Like, we're ticking boxes with this company we've been looking at, and then the market cap is $3.81 billion. So you imagine if you're someone like Warren Buffett, he sees this business, he's like, oh my gosh, like even if these numbers are spectacular and whatever, but hang on, the whole company itself is only $3.8 billion. I've got to try and get $100 odd billion into the market. Like, is it literally even worth it for me to buy that company? Well, no, it's not. I mean, it's going to significantly increase the amount of work he has to do to keep up with that company, and really, it's kind of like, to us, do we pick up the 5-cent piece on the ground? I mean, it's probably like the annoyance of having to carry around a 5-cent piece. It probably outweighs the benefit of picking it up off the ground. It's like that's what Warren Buffett kind of sees for most circumstances. Like, yeah, this company is fantastic, but like, whether a 5-cent piece can turn itself into a 6-cent piece, it doesn't really matter to Warren Buffett. Like, he just wouldn't care. He's trying to find, $100 bills that'll turn themselves into $150 bills.
Yeah, and the thing to sort of add on to that as well is that, I mean, he could pick up the 5-cent piece, and he could pick up a lot of 5-cent pieces, but then in reality, all of those 5-cent pieces are businesses that he needs to understand. Yeah. And if he's going to, I mean, he'd have to pick up, hundreds of them.
Yeah,
and
literally.
Then he just becomes like every other fund manager who never outperforms the market because they have 600 stocks in their portfolio and they are not familiar with any of them.
Exactly right. Like, think about that, going back to that 5-cent piece example. If he picks up 100 5-cent pieces, you do what you're saying. You have to know a lot about each one of them. I mean, imagine if you had 100 5-cent pieces in front of you, and for each one, you just had to remember one thing about it. You just had to remember the year that it was made, that was printed on the back of the coin. That's the only thing you had to remember.
That's a good example.
About 100 different 5-cent pieces. Chances are it would take you an extraordinarily long time to memorize just that one piece of information about each 5-cent piece.
Yeah, I mean, I'd love to just ask a fund manager who has like 200 companies in his portfolio, just name them.
Yeah, name your investments.
What
Surely.
do you own?
Yeah.
What businesses do you own on behalf of maybe thousands or tens of thousands of individual investors?
Yeah.
Tell me.
I reckon they'd get to about 25, 30, and then they'd just be like, oh, shit, I don't know the rest.
Yeah, and you're right. I mean, just remembering something as like a name or a date would be hard enough for 200 for 200 things in a list, but you have to know quite a lot more than that to outperform the market. And Buffett kind of has laid out these principles that as an individual, maybe you have the ability to pick what's his punch card rule, 10 to 20, I think, of your lifetime. Over your lifetime. So you're talking about learning about a new business and deeply understanding a new business every couple of years, really, or every few years. And that's kind of been his principles. And the other thing I just wanted to say on this is that Buffett's number one rule is don't lose money. And that means that when all of these sort of factors are impacting his ability to find investments, he's always going to lean on the side of protecting the shareholders of Berkshire, protecting their wealth. And I think that also plays into why he's holding on to so much cash. He realizes that there's so many people who have invested a lot of their wealth into Berkshire. They're not sort of the typical investors who maybe are as diversified among other businesses. There's lots of people who just have their life savings invested in Berkshire and have had it that way for quite some time.
A long time. Yeah.
And he takes that very, very seriously, to the point where he would much rather be a little bit more conservative and underperform the market in those later years, rather than changing his strategy or investing in businesses that he doesn't understand, in order to try and outperform the market and risk losing money for those investors. So yeah, I think, I think that unless we see some kind of Great Depression-sized crash of 70 or 80%, the businesses that are available to him to invest in are probably not going to get cheap enough for him to outperform the market.
He's in a bit of a tough spot, really. Yeah, for all those mentions that all those reasons that we've mentioned. I mean, it just goes back to the idea of that's why people say it's actually much easier for someone with not a lot of money to make big returns than someone that's got a hell of a lot of money. Like, a lot of people feel like, oh, you've got so much money. Oh, it must be so much easier for you to generate returns. It's actually harder. It's harder to generate returns the more money you've got. It's easier to make returns if you've got less money as an investor.
Yeah, definitely.
With that said, should we move on? We don't really have too many news stories to talk about today. I don't know. It was just an incredibly slow news week, I found.
Yeah, it was.
It really wasn't too much. I've got one to talk about here, which kind of caught my attention because I didn't even know this was happening. But Brazil is almost overtaking the United States for coronavirus, which is pretty insane. I'll read you what the article says. A surging coronavirus is ravaging parts of Latin America, setting records for cases and deaths in the world's most unequal region, even as the pandemic's march slows in much of Europe, Asia, and the United States. So it's pretty insane. Latin America's two largest nations, Mexico and Brazil, reported record numbers of infections and deaths almost daily this week, fueling criticism of their presidents who have slow-walked shutdowns in an attempt to limit economic damage. So I find this really interesting because it's just it pulls back into the equation this massive kind of moral quandary that people are, or that leaders are facing at the moment. Really, with the coronavirus and all that's happened, I think you've got two main problems. You've got economic impact, and then you've got death or health impact. You've essentially got two situations where if you shut everything down, then a lot of people get financially devastated, but less people die, which sounds good. But then again, if you keep the other situation is if you keep things open, then some people die, but people aren't financially devastated. So it's like which one? And this is why I wouldn't like to be a policymaker right now. I mean, you're basically playing with outcomes where either people are, losing their businesses, losing their life savings, losing a lot of money, or do you play with people dying? I mean, and it's hard because few people die, but a lot of people will be few people die from the virus, but a lot of people will be financially impacted. So it's like, because if you just put them side by side and it's like, would you rather be financially impacted or dead? It's like, well, obviously you'd rather be financially impacted. Yeah. But it's the fact that a lot of people will be financially impacted, but not a lot of people will die. That's the hard thing. Well, yeah, like comparatively speaking, like obviously I know a lot of people are dying and it's very sad, but like comparatively speaking, not a lot of people die versus the amount of people that are financially impacted. So
yeah, and there's really no right answer with this. I mean, obviously we know that on both ends of the extreme, the policy doesn't really make any sense. I mean, you don't want to just not consider health consequences and just, onward with the economy. And at the same time, you don't want to completely decimate the economy if say like there's for example, the flu, for example, we don't shut down the world economy every year during flu season.
Yeah, a couple of thousand people die from the flu. Yeah.
Yeah, you have to, there's kind of got to be some middle ground there where you make a judgment between, well, how fatal is this? How quickly does it spread? Do we have a vaccine for it? What's the consequences of shutting down, I guess, on the economy and balancing those things. And it's challenging. It's certainly challenging. And I think, the answer kind of I think the problem gets a little bit easier once we have a vaccine that works for this, because then the ability for it to spread and the numbers will be substantially dulled down.
Yeah.
But when you don't have a vaccine, it's like, well, we could just continue to shut down, and we would most certainly see very, very limited numbers of deaths and cases in Australia. We're having a handful of cases every day, right? And basically no further deaths, I think, or maybe there was one in the last month or so.
It's slowing down, certainly.
Yeah. So we could just continue being shut down. And no one else is going to die probably, but what's the economic consequence of that?
Yeah,
how long it's challenging. And I mean, there's certainly, Brazil, I didn't even know that was happening. And I presume Brazil's quite a small country.
Yeah, I'm not sure.
I can't imagine.
It's a big country in terms of land area, but
Brazil population. Let's have a look.
Okay,
they have
it's
a lot of people.
It's a big country, over 200 million.
Yeah.
So that's crazy.
Wow, okay. So they're almost the size of the US.
Not quite. It's still a way away.
Not quite, like 50%.
Yeah, well, it's three. I think the United States is like 320, 330 million. Yeah, so it's still a decent chunk. Yeah.
But no, I didn't hear about this. But yeah, I mean, it's kind of one of these things. I mean, I've probably said this a few times, but it's one of these things where no one really knows what to do, and we can only really look back and see what sort of pockets of the world did and which parts worked, and then kind of just improve from there, because this has kind of been something that we haven't experienced. Certainly not in the way that in the way that sort of the world economy operates now, in that many countries are reliant on other countries, and we have the internet where information just gets blasted out instantly, and everyone kind of knows what's going on. It's been interesting, certainly, and there'll be a lot of lessons to be learned. Yeah,
I saw a good, an interesting article the other day, which is just like, well, this is one of the reasons why, globalization may not actually be a great thing. Like, I always think, globalization's great. Everyone helps each other out. It's, free world. We get to travel here and there, and we get to, export here and there, import here and there. That's fantastic. We kind of all work together, and it helps everyone's economy kind of grows because we're helping each other. But this is one of those arguments where it's like, well, actually, maybe countries do need to be more self-sufficient in different areas, so that if something like this happens, you can't put your own country in a position where you're reliant on other countries, or you can't put yourself in a position where you're reliant on any one thing continuing to happen in case that no longer happens anymore. So yeah, I saw that interesting article the other day where it's like, well, maybe globalization, there's some arguments against it, and obviously this is one of them, that maybe you do want your country to be as self-sufficient as it possibly can be, which I think makes sense.
Yeah, it certainly does. I mean, we've kind of seen a lot of countries go, okay, well, and this kind of makes sense, but we've seen a lot of countries say that, okay, we're putting our people first. Like, if we have the supplies for, if we have the masks and all of this, we're going to be using them first. We don't care if you had international orders for them. Yeah. And yeah, it's interesting. I mean, I think globalization makes sense most of the time, but yeah, it's like if you're heavily reliant on another country, and then that country suddenly turns against you, like there's some kind of pandemic and everyone's going in for themselves, or there's some kind of war, for example, and there's a group of countries that are on the other side of that, and you can no longer get a certain medical supply because you get 100% of that from a certain country, then yeah, it's a concern.
Yeah, for sure.
It's big questions that no one knows the answer to. Yeah, and it's basically just things you just sort of see how they play out over time, and you adapt to them. Yeah. And
yeah, following on from this whole coronavirus talk, I've got this next news story that the Australian government might avoid having to spend $60 billion in coronavirus recovery efforts. That'd be helpful, I would imagine. So the article says the $60 billion is, of course, the money that the government thought it would have to spend between now and September on the JobKeeper payments, but doesn't have to, because there are about 3 million fewer workers enrolled in the scheme that it originally thought were. So that's pretty interesting. The government's response, it says here, now it's true that this isn't exactly free money. It's just the government had planned to borrow, but it hasn't. So they say here, the government's response so far is that it would rather not borrow and thus not spend the cash, leaving the Commonwealth with a lower total debt. So, but then the flip side, the article continues, but it's on this crucial point that the overwhelming consensus of economists, whether they're from academia, think tanks, banks, or elsewhere, pretty much all disagree with the government. Former Reserve Bank board member and now ANU academic Professor Warwick McKibben best sums up the consensus view. He says, we can afford in this country to have a very clear, long government-supported recovery over time in the economy, and I think we should make the most of it. Given how much it costs in terms of the interest rate, close to zero, to borrow, and most activities would give a very high rate of return. This is an ideal opportunity for the government to step in, but have a plan to step out when it's needed. So I can kind of understand that, but I don't know. I can't say I'm an economic expert, so I don't know whether it would be better if the government just doesn't spend that money or if it does, but I can kind of see there's benefits on both sides. You know, JobKeeper isn't as big as what you thought it was going to be. You save 60 billion, it means you're 60 billion less in debt. The economist saying, well, borrow at cheap rates, you know, inject it into the economy, get us going again, help us with our long-term recovery. I don't know. It's interesting.
Yeah, I think my view and understanding of this topic is probably goes as far as what you just explained in that. Yeah. I think that, the more that they borrow, the more pressure there is that there may be more inflation is probably the only thing that I could add to that. Is the more spending they're doing, the more money they're pumping into the economy, you would expect that some kind of inflation would come from that. So less spending might put less pressure on that, but then you could also make the argument that, you know, there's certain times where it's required that you do a substantial amount of spending to sort of kickstart people's confidence and keep people spending at small businesses so that the economy can kind of get going again. But beyond that, I really don't know. Sometimes we see governments make good decisions economically, and sometimes you see them make bad decisions. And the same goes for private businesses. And when it goes wrong, we have a recession, and when it goes well, we don't.
You know, sometimes things are good, and sometimes things are bad.
Sometimes they're bad. Young investors.
You know, I don't know if it's going to be good or bad, but I hope it's good, and because good things are good, and bad things are, well, quite frankly, not so good. And
oh dear, that's pretty much.
Did you hear Trump? What was he talking about the other day? Some crazy clip where he's like, so I've been taking it, hydroxychloroquine. I mean, it's supposed to be good, but I'm almost finished with it. But I think it's overall it's been good. There are some side effects, and some people it's very bad. And it's like, I watched there's this comedian floating around on Twitter that just takes the audio of Trump and mimics the lip syncs to it. But it takes away the whole, you know, the fact that Trump's got 15 people standing behind him and nodding, and, you know, Trump's, you know, hand gestures and all that. It takes all of that away. So her doing this lip syncing really just makes you listen to exactly what he's saying. And when you take away, you know, everyone nodding in agreement, when you take away, you know, his facial expression, all that, and you actually just listen to what he's saying, it is crazy. It is like, I don't understand how a human can make sentences that sound like that. I mean, they just don't make any sense. They literally make no sense. It's just crazy. I mean, he must just be given a brief. Your job is to stand up there on that podium and just speak. That's all you've got to do. You just have to talk. And he takes that quite literally. And he's like, all right, if you say I just got to talk, then I'll just talk. Oh, yeah, hydroxychloroquine. It's good, but it could be bad. And for some people, it's very bad. But for me, it's good. And for some, it's not so good. And you know, America's great, you know. It's like, oh my God.
Oh,
anyway.
He's a funny man.
I think her name's, what's her name? Sarah someone? Sarah
Palin?
No. Sarah Cooper. If you want to have a look at some of these clips I've been talking about, go and research on YouTube or just into Google's Sarah Cooper, and it's hilarious. It's so funny. Anyway, moving on.
Oh dear.
You know, I found another interesting news topic today. Deliveroo motorcyclist was sacked for being too slow. You know, I was thinking, when I read that, I was like, oh, well, that makes sense. I mean, if you're too slow, I mean, the food goes cold. Like, that's probably not a good thing. But then I read that he's a motorcyclist. I'm like, most people that are delivering with Deliveroo on their bikes, right? Like push bikes. It's like, you must be going very slow on a like, how can you even go that slow on a motorbike to be slower than a bicycle that you get sacked for being too slow at delivering food?
Yeah, that is kind of sad. Oh dear. What's he been doing? He's been taking too many rest stops.
Yeah, I've got no idea. Maybe it's just, I don't know, just generally not doing his job. Well, most Australians stayed home to avoid catching the coronavirus. Diogo Franco worked almost every day to deliver takeaway to their doorsteps. It has been his main job for 3 years since he moved to Sydney from his native Brazil. But at the height of the pandemic, Deliveroo sacked him in late April for essentially being too slow. The motorbike courier, 32, also denies Deliveroo's claim that he was too slow in the job. It doesn't make any sense for us riders to drop off the food late, as we don't get paid that much money. It's basically as fast as you can and as safe as possible. You do the drop off. The more orders you get, the more money you make. I mean, that makes sense. Why would you? I mean, how? There must be something that's not. Someone must not be telling the truth, because his explanation makes sense. You just want to make as many deliveries as possible. I don't know. Maybe he's got an app that's not working or something.
Yeah, that is weird.
How funny is that though?
So, didn't even know you could get. I mean, it kind of makes sense, I guess. If you were consistently not delivering food on time, it kind of makes sense. But yeah,
if you're handing people their pizza and it's stone cold. It's pretty funny though.
Oh no,
man. Anyway, that's kind of like a non-news story. It just caught my attention. I thought I'd chuck it in here. Here's another news story I wanted to go through. Right, so this is really interesting. There's been some potentially shady stuff going on with Airbnb, trying to save money on people that are, or trying to make money off of people that are being impacted by the fact that their holidays might not go ahead based on coronavirus shutdowns.
Yeah, I actually have some stuff to add to this, because I had a holiday that was booked for July through Airbnb. And I had to deal with this exact policy that you're about to explain.
Really?
So,
okay.
So
this is my understanding of it. I did do a bit of reading because it seemed very confusing, so I wanted to try and wrap my head around it. So it sounds like on the 19th of March, Airbnb introduced a coronavirus-specific extenuating circumstances policy. This policy allowed people to cancel and get a full cash refund or travel credit in the amount they paid if they cancel within certain dates and prove the cancellation is due to COVID-19 related travel restrictions. So their website says our extenuating circumstances policy is intended to protect guests and hosts from unforeseen circumstances that arise after booking. So that was on the 19th of March. So coronavirus was definitely, in full swing. Like, it was caught on in January, really got bad in February, really got bad in March. That's when everything shut down. So even having this policy come out on the 19th of March, they're kind of behind the eight ball a little bit. They're a little bit late. And then anyway, so they did that in March, and then in April, so after the fact, in April, Airbnb updated its policy to specify that reservations that were already cancelled before the March 19th policy will not be considered for a refund. So essentially what you've got is a lot of people cancelling in January, February, and the first 2-3 weeks of March, specifically due to the coronavirus lockdown concerns, travel restrictions, whatever. But because they cancelled before the extenuating circumstances policy was put up on their website on the 19th of March, they've now gone in after the fact and say that people that cancelled before, even though it was due to coronavirus, because they cancelled before our policy was updated on the website, we don't have to give you a refund. So essentially Airbnb seems to have just implemented this crazy money-saving tactic where it seems like they're helping people out with coronavirus, but most of the people that have cancelled before March 19th are now not going to get a refund. Is that right? That seems crazy.
It is crazy.
And the fact that it's crazy, sorry, just to go on, it's crazy the fact that they added this rule in after the fact in April. It's like they should have just put that in the 19th of March thing. If you cancelled before, so be it. Too bad. So sad. But it's like they then went back in April and changed it after the fact. I don't know.
Yeah. And there are some bookings where if you cancel, say, a month before your trip or longer, you get a partial refund. So I'm sure a lot of people in Jan, Feb would have been thinking, if we wait any longer, we might get nothing because there was no policy. So let's cancel now. Let's lock in at least. Pressure. Yeah, so and that's not typical. Most of what I've seen when I've booked stuff on Airbnb is that if you cancel any time after, if you book it and then a couple of days go by, most of the time, if you cancel any time leading up to the reservation, the check-in date, you lose everything. So most of the time that doesn't apply, but there are some circumstances where you could get a partial refund.
Right.
For us, fortunately, when we were booking ours, I was just waiting. I was in communications with Airbnb constantly trying to get a refund. I was not going to accept anything kind of less, and they kept like sort of updating the dates in which you could get a refund, cancel and get a refund based on when you checked in. And they kept moving it forward by 1 week at a time. And I just kept watching it get closer and closer and closer to our check-in date. Yeah. And I noticed that they made an update to it quite a while ago where they basically set the cutoff date just before the school holidays period, where I assumed that there was quite a lot of bookings that they really probably didn't want to have to refund.
Right.
And they left it there for a really, really long time. And I was actually worried that they weren't going to move it into the holiday period because I was worried that there would be too many cancellations and that the company might actually be in trouble. And they know that. But recently, I think it was last week actually, they moved it finally to include the school holiday period. So I was able to get a credit. I didn't get a full refund because for a full refund, you had to provide documentation proving why you couldn't travel.
Really?
And even though there's travel restrictions now, I don't know if that would hold up because there's no sort of proof that the travel restrictions internationally would still exist in June, July. So I figured the best thing to do is just get a credit refund, and rebook at some point in the future. But yeah, it's very dodgy that they added that in April because clearly their policy wasn't clear enough when they first made it, and now they're trying to patch it up. And if it's not clear enough, then there's definitely a case to be made for those people to say it wasn't clear that if we cancelled before, even though it was for the same reason. So
yeah, no, I think if you argued that one hard enough, they'd cave. But,
I think so too.
Yeah, super interesting. So have you gotten your partial refund?
Yeah, so we've got a full credit. So
you got the credit. You got the credit, right?
Yeah. So we got the full amount.
Here's an interesting thing, kind of semi-related, is that me and my friends were going to go on a cruise. We'd planned this a long, long time ago. We're going to go on a cruise in July. Now, obviously, that is not going to happen. We were going to go with Royal Caribbean. And obviously that our cruise got cancelled. So we called up and asked for a refund on our deposit. And they said, yeah, no worries. Obviously your cruise is cancelled. We got to refund you. And then the thing we didn't realize is that then they sent through an email saying your refund will be processed in the next 6 to 9 months. How crazy is that?
Yeah, they don't have enough money.
Yeah, exactly right. And that's what, of course, all of my friends who really don't pay attention to this sort of stuff, they're like, oh, man, they must be overrun with people requesting refunds. They must just not be able to process them all. Man, they've got to process 6 to 9 months worth. Man, that's crazy. I'm like, no. That's not what's going on. This is, they are trying to hold on to our money as long as they possibly can before they have to give it back.
Yeah, because if they are screwed. If they had to pay out all of the deposit that they had accrued,
they're bankrupt.
It would bankrupt them.
They're bankrupt if they have to do that.
Yeah. It's strange that they can say, okay, we'll give it to you in 9 months. I wonder if there's a way that you could push hard enough to make them give it to you.
To me, and I haven't looked into the rules, but it doesn't seem to be fair. I don't think it would, it doesn't seem to be fair that a company is able to hold on to your money for 6 to 9 months after you request it back for a refund which you're completely eligible for. I mean, they're not going to give it, like our cruise was supposed to be in July and we may not get our deposit back for that cruise until well after July. So this is months after our cruise was actually supposed to happen.
Oh, okay. Wow. That's interesting as well.
Yeah.
Yeah.
So, I mean, this it is clearly a tactic for them to hold on to our money for as long as possible. But
Yeah.
I wonder if you did just fire back with an email saying, no, we don't want you holding on to our money for 6 to 9 months. We need you to give it back now. I wonder if they'd just be like, oh, yes, of course, sorry.
Yeah, it's interesting because it's kind of like, well, if I demand it now and enough people also do that, then we might not get it at all. But then the other argument is also, anything could happen over the next 6 to 9 months.
Yeah,
where they
for
just
sure.
go bankrupt and you could just not get your money back.
Not get it back. Yeah.
Like that's a long time. Like that's kind of like investing in Royal Caribbean for the next 6 to 9 months.
Yeah, you might not get your money back.
I wouldn't put my money. I wouldn't put my money in Carnival stock for the next 6 to 9 months. But yeah, it's an interesting situation when businesses are kind of on the ropes and they have these obligations that they need to pay, and they're just trying to kind of weasel out of it for as long as possible to stay alive.
Pretty much. Yeah. Yep. But I would not like to be. I wouldn't like to be working for admin for a cruise company right now. That would be hell. I feel sorry for those people. Yeah. I'd ask for a pay rise. I'd just be like, you got to pay me more.
Yeah.
But anyway, shall we go into some Q&A? What do you reckon?
Yeah. Let's do it. Yeah. So should I read this first one to you?
Yeah, sure. Go for it.
Yeah. So the question reads, will I make higher returns if I treat ETFs like individual companies and buy when the market is down and sell when the market is up, as opposed to passive investing?
Well, I mean, if you looked back in history and you saw the market going up and down and up and down and up and down, then obviously you would make so much more money if you bought your ETFs always when the market bottomed and you sold always when the market peaked. But that's the thing, is that we're talking about the past. So hindsight is a wonderful thing. But when it comes to ETFs, and investing in general, we're trying to look to what's going to happen in the future. And the future's hard to predict, it's hard to know what's going to happen because it hasn't happened yet. So the thing I would say is, yes, it's a great idea to buy any investment when it goes down, when the market's down, and sell it when the investment's up and the market's up. I mean, that's just your fundamental rule. First, most basic rule of investing is to buy low and sell high, right? But the thing that I would say is that I don't know if the market is I have a couple of measures where I can judge whether the market's hot or, if it's overvalued or undervalued. But that doesn't necessarily mean I know when the market is going to peak and I know when the market is going to crash. I mean, the market's been overvalued. It's been hot for a very long time. But even though it's been overvalued, it's continued to surge up and up and up and up. So, if I didn't invest back then I would have lost out on potentially 20, 30%. So I would just say, for me, looking out to the future, I don't know when the market is, when the price of the market is going to be at its lowest or at its highest. I definitely do think that as a passive investor, you do want to take advantage of times, if you're going to hold your ETFs for a very long time, you want to take advantage of the times where the market has really come off the boil and has sunk quite dramatically, because that will help your ultra long-term rate of return go up. But yeah, I don't concern myself when it comes to ETFs. I mean, we say this a lot on this podcast, but we don't concern ourselves with trying to time the market with an ETF. We just dollar cost average and just, keep showing up, and then hope that, in 40 years' time, then history kind of continues as it has done in the past, and we average out to a 6, 7, 8, 9% annual average return.
Yeah. The question you just need to sort of ask yourself is, after what percentage drop are you going to start buying? And after what percentage increase are you going to start selling? Because in 2008, it was 50%. In late, 2018, it was 17%. This year, it was 37%. It's never the same. It's always different. And there's just, as nice as it would be to be able to look at the market and be like, yeah, this is the bottom, or this is the top. You just can't do it. No one has been able to do that consistently.
I mean, the articles we were reading, sorry to butt in, the articles we were reading, not a month ago, maybe 2 months ago in March, when the market had gone down 35%, the articles we were reading is the market's going to go down 60%, 50%, 60%. And then, oh, wait, no, it didn't do that. I mean, you can't predict it. No one can.
Yeah, as much as I hate the fact that stocks didn't get cheaper so that I could invest more, the amount of negative news that has come out over the past few weeks and how the market has done the complete opposite is kind of spectacular. The amount of times that I saw people say this will not be a V-shaped recovery. And we're almost back at the highs that the market was at. I think the Australian market is above its highs, and the US market's still quite a bit down, but it's moving in that direction. So there's just no way to know what the market is going to do ultimately. And if you the answer to your question is if you had a crystal ball and you could shake it and find out when the market was going to bottom and peak all the time, then yes, you would make more money. But in reality, you will most likely lose more money. It's gambling if you want to do that. And you might lose and you might win. But you could just easily dollar cost average into that ETF and collect the average. And over the long term, the average has done quite well. So that's my answer.
All right. Full marks. Well done.
Thank you.
All right. This question comes in from Brandon in the ACT. I have a question for you, Hamish. Yeah. Oh. I don't know who wrote this one. So this person says, I recently made a video about value or price traps. So the example I used was, US airlines and cruise line companies, and the fact that I was saying that they're value or price traps because, these companies have literally taken on in some cases more than $10 billion of debt. And in my opinion, that takes a lot away from the upside of being a long-term shareholder in some of these businesses, right? And this is kind of what Warren Buffett was talking about in his annual shareholder meeting where, he was talking about why he decided to leave. Well, one of the reasons why he decided to leave the airlines is because they're taking on huge chunks of debt and they're going to have to pay that debt back and the interest on that debt back out of their future earnings. So when you look at things from a long-term shareholder perspective, the business might not actually go anywhere for a while just because they're staying alive now by taking on debt, but they're going to be servicing that debt for so long that, are we really going to make a great return out of it? So I made that video, and then the comments that I was getting is, what do you know? Because I'm looking at the airline stocks or the cruise line stocks, and I've made 10% in one day. Of course, that's very short term, and remains to be seen what happens over the next 10 years with these companies. But a lot of people, jumped on the idea straight away that you don't know what you're talking about because all of a sudden in 2 days these stocks have gone up 10%. So I guess my question was, is there any point where you look at a company and you say, you know what, I actually don't care about the fact that in 5 years they might be still paying back debts. Or anything, even if there's a potential they might go bankrupt? Is there a price point where if a stock can get down so low where you're just like, you know what, the risk is worth it just to try and get in at this price?
No.
Okay.
And is the short answer.
I thought that's what you were going to say, but I was interested, if the stock is that beaten down, is there any point where you're just like, I may as well just take a little gamble on it?
Yeah, so there's something to say here. Okay, in terms of when you're projecting future cash flows for a business, if you pay a lower price, then the bar for how much cash that business needs to return to you is lower. And as a result, if a business if debt's out of the picture, then the lower price that you pay for a really great business, the less it needs to perform in the future in order for you to make a return. But there's no price that you can pay that's low enough to reduce the risk of bankruptcy in a company that has a large amount of debt. And that's kind of you kind of need to think about investing in businesses. If you're looking over the long term, there's the long-term cash flows that you're concerned about. You need to think about what the business can produce. And in that way, price matters. But in the short term, you need to make sure that the business isn't in a financial position where it could be completely erased. And that's kind of been the situation with a lot of, the airline businesses and the cruise line businesses. And I was speaking to someone about this the other day and about the lesson that I've learned and that I think a lot of people have learned over the past couple months is that if you took me back 6 months ago and you asked me, or let's say a year ago, if you took me back a year ago and you asked me, could there ever be a situation or could you imagine a situation where the airlines are completely shut down for 4 to 6 months? I would have, thought about it a lot,
no.
and I would have said, no, I actually can't think of a situation where that would happen. Even if there was a world war going on in parts of the world, flights would probably still be operating in other parts of the world.
For sure.
So, and the point, the lesson that I've sort of learned out of this is that the reason why you want companies with low to no debt is because you cannot imagine or think about all of the future possibilities. There will always be things that you miss. And by just saying I avoid companies with no debt, then you don't get into the position where, you didn't think about the fact that a pandemic could cause airlines to shut down completely and half of them to go bankrupt that we might kind of see over the remainder of this year. So it's just a simple way for you to not have to think about and know all of the future possibilities of what could happen. And that's kind of been the lesson that I think I've probably learned is that as much as I would have liked to think that I knew about investing, I've learned that there's always things that can happen that just unpredictable things. And as a result, it kind of reinforced how important it is that the business is really solid fundamentally, and that you're not just speculating on companies with high levels of debt and no earnings or in industries that are really challenging. So
it's reassuring.
What are your sort of thoughts on that?
Well, I agree. I mean, that's kind of why I made the video, is that, investing for me is really not a game of gambling. I have made speculative investments in the past, but they've only been very minor positions in the portfolio. So, I mean, really for 90% plus of my portfolio, it's about finding businesses that are in a rock solid position that have potential to grow at a healthy rate into the future, and buy them if I can get them at a margin of safety price. Then I'll buy them then. My investing philosophy is not this company might go bankrupt, but if it doesn't, I might make a healthy return, because there's so many mights. It might do this, it might do that, it might do this. If you look at a company like a Google or a Facebook, where you look at their balance sheet and you're just like, holy moly, it would take something seriously worrying for these companies to go bankrupt. You're like, oh, all of a sudden, okay, so these companies are like super, super solid financially. Like, it would take something ridiculous to put them out of business. And you're like, okay, well, I start to look at those companies more and, look at what they're doing, what they're up to, and what they might do into the future, and check their growth has been good and they're managed well. I'm like, oh, okay, those are the companies that I'm more interested in. I'm not interested in but this company might make the vaccine for the coronavirus. I'm just interested in ones that, okay, this company's done well in the past, it's going to do well in the future, and it's got a rock solid balance sheet to get it through that. They're the companies I'm more interested in, but that's just me. It's kind of sad, to be honest, because I feel like that would be a much better investing philosophy for most people to have. And I just looking at that video and how many people are just commenting, falling into that same speculative gambling kind of mentality, it just worries me, man. It just worries me a little bit.
Yeah, well, it certainly doesn't help when you have 9 out of 10 channels on YouTube talking about investing in cruise line companies. So
yeah.
And
I mean, it's sad because that's always going to be the way it works, because that's what people click on.
Yeah.
I mean, people are talking about the cruise line industry, so they're going to click on a video that says, cruise line stocks, a massive buy right now. I just bought $100,000 of whatever it is, Carnival Cruise Line or whatever. It's just like, people are always going to click on those videos. But people just need to realize that the people that make those videos are profiting on the fact that you just clicked on that video. Anyway.
Yeah. Anyway, that's probably a good place to end it.
Topic for another day.
Yeah, topic for another day. A day far into the future.
Oh gosh. Don't get us started. Don't get us started. Anyway.
Yeah, that's another hour right there.
Yeah. No, thanks for listening, guys. We appreciate it as always. I didn't see too many questions in the most recent, in our most recent podcast, in the comments section of the most recent podcast over on YouTube. So if you do have a question, feel free to drop it. Just go over to Young Investors Podcast on YouTube and click on the most recent podcasts, so obviously this one, and this one for this week anyway, and just drop us a comment. If you wanted to ask us a question, we always like to answer your questions. So make sure you head over to youtube.com/Young Investors.
Young Investors Podcast.
Young Investors Podcast. Yep, cool. And drop us a comment and leave a like and share it with all your friends, and we appreciate it.
Yeah, and thanks to our sponsor, Sharesight. So again, if you want to go and try it out for free, you can. There's a free plan. So head over to sharesight.com/young investors. And if you do want to sign up to a paid plan, you can get 4 months free when you sign up for a yearly subscription. So go check that out if you're interested. And again, thanks again to Sharesight for allowing us to do this podcast.
It's actually a good deal. It's actually a good deal. Like, how many times do you listen to like sponsor like advertisements or whatever, and you're just like skip, because you just know that this is just going to be garbage. But like it's 4 months. It is 4 months, didn't you say? 4 months free of Sharesight.
Yeah,
it's actually
so
pretty good. But anyways, check it out if you're interested. But I think that'll do us for today. We got to get out of here. We got YouTube videos to make. We got businesses to run. But no, thanks very much for listening, guys. Take it easy, and we'll see you guys next week.
See you guys.